Hello, good morning.
Hey, how's it going?
It is going. Thanks so much for being here today. I really appreciate it. So glad that we could connect on here. Thank you, FinTech Sandbox, for having us, Boston FinTech Week. So I am Alex Roa. I am the assistant editor at FinLedger, and I am here today with Andrew, CEO and co-founder of Clearco, for a little fireside chat, a little early morning fireside chat. I love it. Where are
Yeah.
you based out of right now?
I'm currently in New York. Our
Okay.
team is primarily, well, started in Toronto, but we are now global. So
Yeah.
we've got teams around the world, but I'm in New York right now with my leadership team.
Oh, I love it. Fabulous. What a good time to be in New York too. The weather's like changing, so it's perfect.
It's perfect.
Yeah, awesome. Well, let's kind of like just dive in today. We haven't had a chance to really speak before, so I'm really excited to finally get to meet you face to face.
Yeah,
And I think for our audience, I think the best way to kind of start this is to just introduce them to Clearco, kind of what you guys are doing, and then I think the best plan of action for us is to dive into maybe some democratization of technology, how you guys are helping build wealth, and we can just kind of take it from there. How does that sound?
that sounds fantastic.
Fabulous. So go ahead, introduce us to Clearco.
Yeah, so we started Clearco in 2015, really with this mission of, how do we empower, the millions of entrepreneurs and founders around the world with some of the benefits that a very, very, the 1% of the 1% have in Silicon Valley. And maybe many people on this call, many people who have been able to go raise venture capital and have sort of investors and advisors that can help guide them through this. There are millions of entrepreneurs in the world that will never have that access. And so, we aim to go and help basically back that group of founders and give them all the benefits that traditional venture capital has. And so my background prior to that, I was an engineer. I was an immigrant, grew up, born in India, moved to Chicago, and then grew up outside of Toronto. But when I first moved from Toronto to Silicon Valley, I think that was probably one of my first moments where I realized that my friends that were starting businesses in every other part of the world just didn't have the same benefits of the people who went to the same parties as the VCs, or went to the same conferences and events, or went to the same universities. And so that was sort of how we got started. I moved back to Toronto. I became a bit of a bridge between the emerging Toronto tech ecosystem and Silicon Valley. Met my co-founder, who was raising money for her company, and she ended up selling that business and joined the cast of a show called Dragon's Den, which is our version of Shark Tank in Canada. And so we were starting to see thousands of pitches from across the country, trying to figure out how to help them, and realized we were going to raise our own venture fund, and realized that they probably didn't need venture capital money. They really just needed some help on funding things like marketing and inventory. And so we designed a product where we would fund them on a revenue share basis. We'd fund specific repeatable expenses. That business has grown to over $2 billion, over 5,500 businesses around the world, but still very, very early in the journey. We've got a plan to go and back 1 million founders, and so 5,500 is a lot, but not nearly as many as we need to.
Absolutely, definitely. Can you kind of walk me through how the tech itself works, and kind of how that recurring revenue kind of happens?
Yeah. So the way that it works is, as most of our customers are e-commerce or software SaaS businesses, and so they'll come in, they'll plug in their online systems, their payment processor, their ad accounts, their banking information, but whatever systems they use to run their business, we're able to ingest that data, compare it to tens of thousands of similar businesses that we've seen, build a revenue forecast for that founder. And what we're really aiming to do is, provide more than just access to capital. Like, if you think about the analogy I've started to use, you tell me, my team sometimes hates my analogy, so you tell me if this one lands. But if you think of, like, every founder is like climbing a mountain, right? You're trying to climb Everest. Capital is like your oxygen tank. You need one to get there. But if I just give you an oxygen tank and say good luck, you're probably not going to make it. And so you need a Sherpa, you need a guide, you probably need some training, and so that's really what we're trying to do. Is we're trying to say, look, we can give you capital, but we can also help you become a better capital allocator. And it's because we've seen so many businesses, we can actually help tell you when you should be purchasing your inventory, for example, and which marketing channels you should be advertising on, and what that media mix needs to look like. And so increasingly, we're really starting to help be a partner and almost an advisor to our founders. And the way we're able to do that at the scale that we do is using that data in real time. Every day we can see what's working, what's not working across tens of thousands of businesses, and we can understand sort of what a founder needs to do next to increase their odds of success.
Absolutely, that's fabulous. So you guys mentioned that you are working on a global scale. Is that correct? Or
Yes.
You're working internationally as well? Okay, awesome. So I guess that my question kind of is, so we cover obviously international news as well, and we've noticed that there are challenges in different parts of the world, depending on the nation, depending on the continent. The problems that you're seeing with these founders, the roadblocks that they're hitting with getting money, is this something that is pretty consistent? Would you say that these are the same problems that are happening all over the world, or are they pretty varied throughout? How are you battling those challenges? How are you helping these founders in different parts of the world? What does that look like?
Yeah, no, there's definitely there's nuance in every country for sure, right? If you think that it's hard for founders in America, it's an order of magnitude harder everywhere else in the world for them to have access to funding and support. And that certainly changes depending on where you are. But in most parts of the world, venture capital is not as developed. Banks are not, they're much more risk averse. But there's still this sort of untapped entrepreneurial potential and energy, right? If you think about what a founder really is, it's somebody who sees a future that they want to go create, and they want to build a different future than exists today for themselves, for their family, for the people around them, and especially in today's world, especially for online, internet businesses, e-commerce businesses, SaaS businesses, the only limitation being able to go to the future, in a lot of cases, is access to funding and knowledge of what to do with that funding. And those are the things that we aim to solve. And so the degree of that challenge is different in every country, but what the support that the founders are looking for is actually quite consistent, because they're building businesses for a global world. And if you're an internet entrepreneur, you've got to be thinking about building for a global customer base from day one. And that's what we help people do.
So you guys are, I remember reading up quite a bit on y'all, because obviously it's important to do with your speaker. And you guys promote sort of this bias, or this unbiased and like equity sort of free funding, right? So how, what are the tactics that you guys can share with how you're accessing that audience, and maybe you can share with our audience, what you guys did to make sure that it remains unbiased and equity free?
Yeah, it was, we didn't do this as like a charity thing, right? We actually, it just was a byproduct of, you don't need to have a warm intro to us, and we don't look at your profile. You don't even need to meet us face to face. You don't even need to you just need to have a business that's starting to work, or a business that we think we can help. And it's amazing when you just eliminate all of that bullshit, all of the hoops that we make founders jump through to access capital. And you just say, look, let's just get down to the fundamentals of do you have a business? Do you have a product that customers love? And do you know how to find those customers? And I'm not going to judge what that product is. I'm not going to judge whether I would buy that product or whether I'm the right audience. All I care about is, do you have a business that is viable? And do you have a vision for how to go create that future, or a path to go create that future? And can we help you? And so it's amazing that when you eliminate all of those hoops, the people that show up are much more diverse than the people that will typically walk through the doors of Silicon Valley VC. And so in the U.S., we funded founders in every single state in the country. It's a much more diverse group of founders. From I think it's 8 times more women than the average venture capital fund. It's 30% people of color. And that has been consistent globally. So in the UK, we looked at the data, and 70% of our capital went to founders outside of London, the Greater London area, which is the opposite of what venture capital looks like in the UK. And so I think it's all we've really done is we've said, look, especially in sort of a post-pandemic world, you don't need to meet us in person. We don't need to have a warm introduction. We don't need to pass judgment on your background, your education, how you talk, what you look like. We just care about, are you building an interesting business that the world needs? And can you show that? Does your data, back that up? And if it does, then we're here for you.
Absolutely. We actually have a question from the audience. They're wondering, does your business give you any kind of unique insight into the strengths and trends and different innovation ecosystems around the world?
Yeah, great question. It's something that I'm particularly excited about. I would say our international expansion is still in its early stages. So we're in a number of countries. We actually got a couple of announcements in the next week or two where we're launching a few other major markets. But it's all still very early. I think what I've been most impressed with is just the entrepreneurial energy in sort of every new country that we launched in. So I think every time we launch a new country where you're like, oh, I didn't realize there was such a powerful entrepreneurial ecosystem in that country. We launched the Netherlands a few weeks ago or a couple months ago, and again, like there's just so much untapped, latent sort of entrepreneurial potential in these markets that it makes me really hopeful. Again, like the mission of the company and the reason why I get out of bed every morning is if you think about a world where there are 1 million founders that are solving the problems that they're passionate about and they're kind of creating that future. Sure, it looks like a much more chaotic world than maybe what we live in today, but I think it's our best shot at solving some of humanity's biggest challenges. And so that's and unlocking that from the corners of the planet that otherwise wouldn't have access to that opportunity is a really exciting part of what we get to do.
Absolutely. I know that's something that resonates with our audience a lot, and something I've noticed with a lot of the CEOs and the founders that I have interviewed in the past is that they have actually come to America because it's easier to raise venture capitalism here. It is easier to grab money here. And it's interesting that they gravitate towards here, but I'm so glad to see companies that are taking that venture capitalism that's exceeding here and taking it to other places, right? And helping. It's an entrepreneurial spirit for us that's also pushed into other countries. And I'm congratulations for you guys, on working towards that. You'd mentioned, I think, that there was a certain amount of women founders, people of color founders. What's the diversity you guys are looking at right now? Are you seeing more marginalized groups entering into these founder spaces? Are you guys doing anything to help give them access to funding? What does that look like right now?
Yeah, I think it's always been there, to be honest. Like, I think there's always been entrepreneurial energy and potential in, marginalized groups, people that are cut out of, traditional corporate or financial systems, and it's just never seen, may have never been seen as an effective place to invest, or I mean, maybe more charitably, an easy group to reach, right? And I think that's where, if you think about the way that venture capital works, you hire people, and they get inundated with pitches, and you only have, if you have a human-powered system that is deciding which businesses to get funding, there's only so many hours in the day. So you have to have some filters, and you've got to have some heuristics and some rules of thumb to figure out, okay, how do I filter that? And most of the time, what's proven to be the most effective has been your personal network, and that naturally goes to the people you went to school with, the people that you work with, and the people that relatively come from the same socioeconomic background as you. And so it has structurally been a sort of scarcity, regardless of how much venture capital there is, it still goes through a relatively narrow group of people, and so that creates a scarcity dynamic because there's only so many pitches they can hear, there's only so many investments they can make, and there's only so many boards that they can sit on. What we've tried to do is use technology to flip that into more of an abundance view, which is like there is more than enough capital out there to fund all the great entrepreneurs and the good ideas. We just need to use technology to widen the pipe and get that into the hands of people without you having to go through those hoops and pitch us directly or have that warm introduction to us.
Are you guys using technology that I guess is bias free, or how does your technology, go about helping these founders?
Yeah, so it's just the way that it works is you plug in your data, and that's what drives the decision. It has nothing to do with really anything else about the founder, other than the fundamental data about the business. What that still means is we don't have a great solution for pre-revenue companies, right? So companies, if you've got a founder with an idea, you still probably want to go to an accelerator or go crowdfund your business, prove that your idea actually has some traction before you can come and work with a business like Clearco. But once you've got even a few $1,000s of sales that we can start, our systems can start to pick up on, then we can continue to help you scale from that point.
Yeah, most definitely. What do your clients look like right now, I guess? So what size are these businesses? What size are these founders growing? And a lot of, I guess, is this technology-based companies? Are you looking at, is this sort of anything really? What are the demographics of this right now that are looking to grow? What are those entrepreneurs looking like right now?
Yeah, so they're primarily e-commerce and software businesses. The way that it works, if your customers find you online and they purchase your product online, you deliver your product or service, through an online channel or without, so it's not restaurants and coffee shops, it's businesses that find their customers online, because we know that those companies can scale globally and we can help them. Because the only limitations are access to capital and knowledge of what to do with that capital. It's a really wide range. Our smallest companies are doing, thousands of dollars in sales in a month. Our largest company will do 500 million. So very, very wide range. And I'd say our sweet spot are the sort of 1 to 20 million in annual sales, is probably where the vast majority of our customers are. But we've built some products for the much earlier stages, and we've been able to scale with some much larger companies as well, who are going public and things, and are still, they find a lot of value in our partnership.
Most definitely. We have another question from the audience. So they're asking, do you see any significant differences between the results of your approach and the results of, say, a more traditional approach?
Yeah, I think from a business model standpoint, so the way that our product works is, let's say we were to give you $100,000 to spend on marketing. We would take a fixed portion, we take 5% of sales till we get 106 back. So our upside is capped at basically 6% of the capital that we give out. So what that means is we can't really have many of our portfolio companies fail. We kind of need pretty much everybody to be successful, and so we work really hard to make sure that we provide as much support as we can to make sure that those companies continue to scale and grow effectively. The venture capital approach, and so we don't take equity, we don't take ownership in these companies. We're just taking that revenue share. The venture capital approach is sort of the opposite, which is, you really are looking for the next $100 billion outcome, and so you'll place 20 bets out of your fund, and if you get one of them, it doesn't really matter what happens to the other 19. It's a pretty stressful place to be in when you've got. We had in one of my portfolio companies, we shared a board member with Zoom. And Zoom did incredibly well, and it was like, okay, well, we're not really going to move the needle for this fund necessarily. So I've definitely been, it's a little bit of it's a bit of a different dynamic that you have with your investors, because they just want you to, it's like if you're not on a path to return the entire fund with your investment, then it's hard for them to justify spending as much time with you. And look, VCs, I don't want to, there's a great important place for venture capital. So I don't want this to turn into an anti-VC pitch. I think that, we've taken obviously a lot of venture capital. We love our VC partners. When you're trying to do something that is new and novel, and this is Boston FinTech Week, I think most FinTech actually is trying to do something that has never really been done before and is unproven and is high risk. And that is equity like risk, right? And that's a great place for venture capital, because I don't know, if you spend $1 on a piece of technology or infrastructure innovation, you don't know if that dollar is going to return, $100 or zero. And so that's really where you want to start using your venture capital, is when it's equity like risk with equity like upside. I think where it starts to fall apart is when you're using equity capital to fund pretty repeatable things. And this is what we'd start to see is, entrepreneurs using equity dollars to fund repeatable performance marketing, to fund sort of inventory and working capital. That's when it starts to feel very expensive, because those are lower risk activities. You know that $1 in returns $2 out or $3 out over 6 to 12 months. And once you've got that business model sort of dialed in, there are easier and less expensive ways to fund that growth.
Absolutely. Are you guys mentoring them at all in how to not do this, I guess, repeatable expenses that you mentioned? What's that mentorship look like?
Yeah, so we build a plan for every business and every founder, where we sort of say, look, here's what your year will look like. Here's when you need to go purchase your inventory. Here's how you could be spending your marketing dollars over the course of the year based on your seasonality and what have you. We launched a product called Clear Angel earlier this year, which is really for that early stage founder. And that is much more sort of mentoring and coaching. It's a multi-year relationship. We pair you up with a coach. We actually we help you. We give you OKRs if you want them. We actually tell you exactly hey, here's what you should do next to make your business more valuable. And so we're really sort of experimenting with how do we be much more hands-on, kind of like a board member, but not your boss. But we're kind of look, we can actually give you the benefits that you would get from an advisor who has seen, thousands and thousands of businesses, to know what to do next. It can be just a very lonely existence as a founder, right? You are, there's so many articles online about what to do. You may ask some friends who have gone through it before, but every business is a bit different, and it's really hard to find somebody who kind of matches your situation perfectly. And that's what we're trying to do, using data and trying to be pretty objective about it, instead of just saying, hey, this is what I feel, or this is what happened with another board that I sat on, or what have you.
Yeah, absolutely. It's funny. I'm, now that I'm on FinTech Twitter, I've seen a lot of tweets about people saying it's probably easier to find your soulmate than your co-founder. And I feel like that resonates with you guys a little bit, So another one of the questions from the audience is, as you expand into these new markets, how will you manage that need to interact with founders in different languages?
Yeah, absolutely great question. It is certainly a challenge. We've prioritized primarily English-speaking markets, so far for that reason. And one of the nice things is throughout Europe, many of the markets, even in so Netherlands, for example, a lot of entrepreneurs speak English, and it's the sort of language of business. And so we've been okay so far, but it is something that is on our plans for 2022, is localizing, hiring coaches and people with those language skills, so that we can actually support them in their local language. So it is a challenge. If you have any advice, I am totally open to it. But it is going to be something that, again, if we're trying to get to 1 million founders, they are not going to exist in the English-speaking world. They're not going to exist only in North America. We need to go meet them where they are, and in a way that makes them comfortable and allows them to operate in their own sort of language.
Absolutely. And just even going beyond that, the regulations that exist in different countries as well, right? So we just covered yesterday that KeysPay was the first buy now, pay later in Pakistan. And, there's a reason that it's the first one, right? There's a reason that it's different. There's a reason that, the credit building is different over there. So how are you guys kind of tackling those regulations as well, with it being international? Because that's tough, right? With interchange fees also, if we're just talking about moving money back and forth in different areas, what is y'all's sort of model for that?
Yeah, absolutely. Great question. It's one thing that we spend a lot of time on, is understanding sort of what is the regulatory framework and structure in every country that we operate in. One of the things that we've really been pleasantly surprised at is, because we are bringing capital effectively, almost every government, especially as they're sort of starting to say, okay, how do we rebuild, how do we restart our economies? How do we start to think about this? I think almost everybody recognizes that online is going to be where a lot of new business creation and new business growth is coming from. They also realize that most of their traditional banks, if they're trying to inject stimulus into the economy through their existing banking infrastructure, they don't actually necessarily know how to get that funding into the hands of the online entrepreneurs and businesses. And so we're getting a lot of government support, to the point where we've got some governments kind of lobbying us to be oh, can we move up the list, which is a very fortunate place for us to be. And so we've been able to actually, partner with a lot of a lot of governments to say, look, help us navigate your regulations and help us actually figure out what's the most efficient way to get funding in the hands of your local entrepreneurs to rebuild your economies, and they've been incredibly supportive and enthusiastic in bringing us into their countries.
Absolutely. That's so great to hear too. I've been speaking more and more with regulation and compliance companies, and that sort of marrying of, there is regulation, but it's okay. It's a good thing, right? Like it's how we keep our consumers safe. And it's so great to see like FinTech and the regulation being able to like live side by side rather than, battle it out sometimes.
Yeah.
Absolutely. So there's another audience question. This one's from Kelly Fryer. She asks, what do you think the future of startup funding is going to look like 10, 20 years from now? Will there be new, more accessible funding options for entrepreneurs? What do you think that's going to look like?
Yeah, another good question. So if anybody follows Naval, the founder of AngelList, on Twitter, he's always got some really interesting tweet threads. And one that I found was this idea of permission versus permissionless leverage. And he talks a little bit about, the types of leverage that you can go create as an individual. The more it's permissionless, right? If you're an author, if you write code, then you don't need to ask anybody's permission. You can go create something, and that creates leverage for yourself. Things like labor and capital have been traditionally permission leverage. You've got to convince somebody to work for you. You've got to convince somebody to invest in you. What I'm hoping is we can actually turn capital into permissionless leverage. And what we can start to do is say, look, if you have a business that requires capital to grow and can produce a repeatable return on that capital, you don't need to ask anybody's permission. You don't need to pitch anything. You don't need to get an introduction. You just turn on the tap and it grows. And you can count on that. And so I think that changes, again, the way that people start to think about growing their business, the level of ambition that founders can take. Because if you're starting to think about building your business to be profitable from day one because you don't know where the capital is coming from, the bets that you take, the risks that you take look very different than if you're like, no, I know that as long as I get to this threshold, there will be capital available on a predictable basis. And I don't need to worry about, like somebody's fleeting sort of ideas about that or feelings about my business. Then the way that you build your business looks very different. So in 10 to 20 years, hopefully sooner than that, we will start to see sort of capital become a permissionless component of entrepreneurship and be much more abundant in different structures and match the other big thing is like matching the uses of funds, right? I think traditionally it's been like, hey, here's a bunch of money, I'm going to wire it in your bank account, good luck. And I think public companies, they've got sophisticated finance groups and they sort of say, okay, we're investing in this project. We're going to fund this project using a bond that matures over the life duration of the project, or we're going to fund this project using equity capital or this other sort of capital. And so I think as founders get a little bit more sophisticated around their uses of funds and their capital planning, they can actually optimize their cost of capital, their ownership, their control, and things. And I think that's one of the areas that we're really trying to help founders navigate.
Interesting. That idea of permissionless capital is so fascinating to me. Grabbing how being able to grab onto that money. We have another audience question. This is from Tony. He said, what's the typical duration of your investments? Are you targeting the same type of companies as venture debt would?
Yeah, so it's typically like 6 to 12 months. I think for our software businesses, we'll go up to about 2 years. So similar. Most of them are a little bit shorter duration because the payback periods on the uses of funds are shorter. But it's a little bit different than venture debt because almost all venture debt requires you to have venture capital, right? So venture debt typically underwrites you against the equity value of your company and against the caliber of your venture capital investors. And so there, if you think about the venture capital world, that is available to 1% of founders. Venture debt is available to a smaller percentage of that. What we're actually aiming to do is actually offer financing to people regardless of what, so we have many, I think probably 15 or 20% of our portfolio has raised some venture capital. So we certainly the larger ones, the ones that are doing north of 100 million, have raised venture capital through their life cycle. And they're just trying to optimize their equity dollars, which they find are quite expensive. But the majority of our companies have never raised venture capital and have no intention of, which means that venture debt is typically not available to them. And so it's a little bit different in that case. We also don't do things like take warrants or overall security in the business. What we do is quite different than a traditional loan. It is a true revenue share agreement. So we are partnering. We get a share of the revenue as the revenue goes up. We get paid back faster. If the revenue declines, we get paid back slower. And so that's really what we underwrite to.
Sorry, I was looking for that unmute button.
Yeah.
So I guess, more and more fintech companies are gravitating towards these raising large seed rounds. Really, it feels like capital, it's flowing very easily. Do you think this is going to last? What do you think fintechs are doing to command more attention right now?
I think that investors are just starting to wrap their head around the scale of financial services globally. And I mean, it's, my co-founder told me this, Michelle, she was like, if you look at the biggest building in every city, it is, the biggest like 5 to 10 buildings are banks. And that has been the case, for centuries. And so, or as long as they were buildings, maybe centuries or a century or two. But, I think we're starting to realize, especially for global companies that are tapping into global markets, I think investors are starting to realize how quickly these businesses can become large, important and impactful businesses. And the scale people didn't really understand how quickly those industries can shift, and they're starting to realize that now. And so, I think that's why there's a lot of enthusiasm for fintech companies that are starting to show the patterns and behaviors of getting to massive scale and getting to global scale, and doing things that traditional financial institutions are probably just not equipped to do, or from a structural standpoint, or probably are probably on their back foot a little bit around, or capturing opportunities that would be hard for them to do in the existing way of doing things.
Oh, most definitely. No, a lot of what we've seen coverage-wise, a lot of what our audience is really gravitating towards is that idea of fintech marrying legacy tech, right? Like, in humans working alongside fintech, that fintech doesn't have to replace people, it can live alongside it. And a lot of the stories that get the most clicks are people wondering, where is all that money going, right? Like, who's spending money on what, and what are the names that are booming right now, right? So you've got like your Plaids and your Stripes, but also these little seed rounds, right? Because these seed rounds are growing so much.
Yeah.
We have another question. So what were the disadvantages and possibly disadvantages of starting and building Clearco in Toronto? So what does the Toronto fintech startup scene look like?
Yeah, I'm a huge fan of the Toronto fintech scene. I'm an investor in many Toronto fintech companies, and many of the other Toronto fintech founders are investors in Clearco. So it is a very, very tight-knit community, and it's one of these situations where Canada has 5 major banks. So very unlike the U.S., there's 5 major banks that control the entire ecosystem. It's very, very oligopolistic, and Canadians spend a lot on financial services compared to any other country in the world. And so there's a lot of opportunity for disruption. We're starting to see that with companies like Wealthsimple. Good friend of mine, Mike Katchen, runs that business, and we're investors in each other's companies. But I think there's 2 major advantages that I've found. One is starting a business in Toronto, and Canada has forced us to be a global business from day one. We knew that to build a business of the scale with the impact that we wanted to, it couldn't be a Canadian-only focused business. And so, yes, we are a Toronto headquartered company, but we're a global company. Our team sits globally. We're across multiple time zones. People speak different languages. I'd say more than half of our company was not born in Canada, and so it's just one of these other dynamics of being in a very cosmopolitan city. And then the talent has been incredible. We've been able to tap into just incredible global talent and local talent in Canada that is not available in many other cities around the world. And so it's really been an incredible place to build and as a foundation. Now we're hiring in many other places and continuing to scale, but Toronto will always kind of be home.
Were there any disadvantages to being in Toronto, or was it just like the perfect fit?
I mean, it was. Look, the other advantage is like my co-founder's on TV in Canada, and so we definitely had some recruiting advantages there. Look, not being in the early stages, not being in probably Silicon Valley made it that we had to maintain that connectivity. For us to raise our first rounds of funding, we went through a program, a YC program called the YC Fellowship. In 2015, which was like a short-lived program where YC didn't take any equity because these companies, we weren't even formed as a business when they like backed us. So it was just a grant, and so we went through that program. That actually helped us sort of like build some initial connectivity to Silicon Valley. But then we realized we were hiring Canadians and moving them down, and so we were like, oh, we should just move back to Canada. But yeah, there were definitely there's not being in the hub of where the money is flowing meant that. A lot more travel for me, and a lot more sort of intentional effort to stay close to investors. But net, I think it was worth it to be in the position we are to grow globally.
Most definitely. We have another question. So, as you hire, what are the most difficult roles to fill?
Great question. It's across the board, like data science has always been FinTech data science has always been a challenging role. People that understand how to use data to help people make better decisions, help our company make better decisions, help our founders make better decisions. Product management is another one that getting somebody with the right. We get a lot of I think because we support entrepreneurs and founders. We get a lot of founders that come, almost we're about 500 people now, and almost everybody has their own founding story. They started a business, they want to start a business, they came from an entrepreneurial family, they're really passionate about entrepreneurship. And so product managers that can come in and really take that founder sort of ethos are definitely challenging. And then continuing to build out our executive team on people and talent, continuing to sort of scale out. That's actually, maybe this is one of the hardest things, is actually the people and talent and culture organization in a global remote sort of environment. Not many people have done this before, and it's been really, really hard for us to make that transition where we were a very in-office, very high energy, very entrepreneurial sort of culture to now being globally distributed and remote. And maintaining that energy and that passion for the mission and for your colleagues has been a challenge. And so working with people who have that, who have done that or have good ideas of how to do that has been a challenging roles to fill.
Most definitely. Are you guys hiring right now?
We certainly are. Yeah.
Do you hear that, audience? They're hiring.
we're hiring
them at Clearco.
globally and across every function in the business. Yeah. We're certainly hiring. We're looking for people who I mean, the most important thing for us is people who have a passion for the mission of what we're trying to accomplish, and can spike in an area that moves the needle for the business, right? So that could be, in the payments world, that could be in sales and go to market, that could be in partnerships and biz dev, that could be in product management, data science, but have a real combination of, a few skills that move the needle for the business and a real passion for, helping 1 million founders and entrepreneurship, sort of saving the world a little bit. And we can find, interesting roles for a lot of those people.
Yeah, most definitely. It's a big mission, but it's a good one to be after for sure.
That's fun.
So we're getting down to about our last 5 minutes. Why do you think alternative financing companies are so popular right now?
I think that there's a lot of equity capital that's flowing in, and so it's easier than it has been to raise equity capital. But I think people are also realizing the cost of that, because if your business is on the trajectory that you think it could be, then your equity becomes incredibly expensive, and so you want to be very judicious about how you use that, how much dilution you take in the early days, and so I think founders don't want to give up growth opportunities, but they also don't want to give up ownership and control. And I think what's happening is there's getting to be look, we're seeing this like in every industry. You see this with athletes, you see this with musicians, like the individual, the person that's taking the risk, the person that's creating, is increasingly, accruing the power in that dynamic. And so what you're seeing with founders is they get to build their business on their own terms, and investors are sort of along for the ride. And so I think that's sort of what's happening is founders are increasingly saying, look, I don't really want to give up ownership and control. I would like to decouple capital and expertise, capital and network. I'm looking at if I need a certain amount of funding to grow my business and to achieve my goals, I don't necessarily need a boss, right? Or somebody who's going to tell me what to do or how to run my business. I have enough confidence in what I'm doing to do this on my own terms. And I think that's part of the reason why we're starting to see a bunch of new models that can enable founders to do that, including sort of alternative forms of capital.
Yeah, most definitely. I completely agree. All right, a couple more minutes. We have some more questions flowing in though. So what steps are you taking to make sure that your use of AI is as unbiased as it can be?
Yeah, this is another great question, and it's something that we're constantly going and reviewing. And I think this is where we look at the types of data that feed into the model, and if it's primarily sort of the business data that is fundamental. Now, if the input data is biased, then you're going to get biased outputs, and so then we also track sort of the outcomes, right? We track sort of, are we maintaining or improving those ratios around the types of founders that we are backing. And while it's certainly better than traditional venture capital, it doesn't perfectly match the population in every country that we're in. And so we're constantly trying to find ways of tracking that, identifying, building awareness. Our hypothesis is it is mostly on the awareness building side of things, that the more we can actually start to get the word out, spread the word, and identify founders in sort of marginalized and underrepresented communities, and reduce the skepticism. I think there's been a lot of businesses that have taken advantage of those communities, and so reducing the skepticism, getting the word out should really help. But we're not. We know we're not immune to sort of some of the biases that can make their way into machine learning models and AI models. And so it is really just about sort of tracking those things over time, tracking those input and output metrics over time to make sure that that's not seeping in.
No, most definitely. I attended FinTech DevCon a couple weeks ago, and I sat on an entire panel that was completely about just teaching engineers how to engineer bias out of your technology, right? And the difficulties that come with that, right? 'Cause they used all these different models that it's not an easy thing to do always, but there's enough, I feel like, companies that are working towards democratizing right now. You've got credit cards that don't have a FICO background score. There's all these different ways to build wealth now, and so congratulations to you guys for finding another way to do that. I love it.
No, thank you. Yeah, it's going to be an exciting future where we can tap into that ecosystem, and that, like, all these people that have been sort of structurally marginalized. I think this is where there's an opportunity to really tap into that massive sort of latent potential, and I think the world is going to be a much more interesting, exciting place when we unleash that. So it's a fun mission to be part of.
Absolutely, definitely. All right, well, I think we're about to get kicked off the stage. So thank you so much, Andrew, for being here. Thank you so much, FinTech Sandbox and FinTech's Boston Week for hosting us. I really appreciate it. And thank you so much for talking about democratization of wealth, because I think it's such an important topic right now. So appreciate you guys so much.
Thanks, Alex.